Assalamualaikum warahmatullahi wabarakatuh and salam sejahtera. Welcome to ACC106 lecture series. This is number 2, the second lecture series that involves the topic of accounting concept, conventions and principles. Actually, there are many accounting concept, conventions and principles that has been laid out by experts. You can Google them up because there are a lot of them. However, for ACC 106, we only cover a few of them. Okay, the first one, accounting concepts that we need to discuss and understand is business entity concept, or some books says economic entity concept, and there are books only recognize the title as entity concept, but they are the same. The business entity concept assume that a business is a completely other unit than the owner, meaning that you need to separate the owner and the business. They are separate entity, even though the money that has been used for the business is from the owner. So you need to bear in mind that those two are separate entity, even though in legal aspect or in law, the owner will not be separated with the business. For example, for sole proprietor and partnerships where the partners are liable to pay any business debt. However, in terms of preparing the records for accounting, you need to separate the business and also the owner, where whenever the owner contribute to the business, we need to recognize it as capital. So we need to record in the account there is a capital, a contribution from the owner. And whenever the owner took something from business, we need to record them as drawings. Moving on to second. So the going concern concept is actually assuming that the business will continue operating in the foreseeable future, meaning that whenever we want to record the business transactions, we assume that the business has an indefinite life. We will not anticipate any closure of the business. So in financial statement, we can see that, or the records in account, then we can see that there are balances to be brought forward to the next year. For example, in financial statement, we will see that asset, equity, and also the liability items will be carried forward for the next year. The next concept we want to discuss is monetary concept. But it's come from the word money. So all the accounting informations will be expressed in monetary terms. So you need to measure them or value them in terms of money so that you can record them in the account. So depends on the country your business reside. Means that if it reside in Malaysia, so the records will be the record will be in ringgit Malaysia. But if your company reside in Thailand, so you will be recorded them in baht. So you need to measure all the items in terms of ringgit Malaysia so that you can record in the accounts. The next accounting concept is accrual-based accounting, where we recognize revenue and expenses even though cash money has not been exchanged. The expenses has been occurred, however, we haven't paid for the expenses. For example, we purchase goods on credit. We will delay the payment. We receive the goods, but we do not pay on that time. So the payment will be made later. So even though the money has not been exchanged, whenever you receive the goods from the supplier, we should recognize them as an expenses, even though we would have not paid that expenses. And also the revenue, whenever it has been occurred, you need to recognize them as revenue, even though the money has not been received yet. For example, you sell off the goods to the customer, and the customer will pay the next month. You should recognize the sales, the revenue, when the sales transactions occurred, not the payment. Okay, let's look on the timeline example when actually to record. Let's say we have a timeline where on the March 28th, the customer ordered the goods from us. We received the order from the customer, and we will send the customer, let's say, on the 1st of April. And when we send the goods, we agreed with the customer. We give the customer a 14 days credit, meaning that the customer can delay the payment for 14 days. So on the 14 days means that the let's say on April 15, the customer paid for the goods. So when it actually to record the sales, we shouldn't record according to accrual based concept. You shouldn't record when the customer paid, means that when the money you have received, because accrual based say that must record when the transaction occur. That is on the 1st of April. You need to recognize, to record the sales, that is the revenue, on the 1st of April, because that is actually the transaction occur. You cannot record the sales when the customer order, because there is a possibility that the customer cancel the order. So you shouldn't record on that particular day, because the sales transactions is assumed not occurred yet. Moving on, for the next concept is comparability. The business financial statements must be prepared in such a way that are comparable. You can compare that your company's financial statement to the other similar company. Means that, let's say you are a restaurant, so you need to compare a financial statement with the other restaurant. But you cannot compare a grocery store with the restaurant, because those are not similar. Or you can compare the financial statement over the past years to do the we call as trend analysis. So you can compare last year how you performed and the last 2 years or the last 5 years. So you should be able to compare, because the financial statement has been made in a certain way. And the business financial statement should also can be compared to the industrial average, where this is you can find this industrial average in the web page of security commissions, or you can Google them, the industrial average for Malaysian industry. So this comparability concept is actually to have this comparability. So you need to follow a guideline or a standard format for you to record and also to prepare the financial statement. So it will be standardized. When it's standardized, then easy for you to compare with the other similar companies of the past years, and also to the industrial average. Next, we will discuss on the neutrality. Neutral, not natural, but neutrality. Okay, neutrality is saying that the information in financial statement should not be biased. You should not taking side for the users. For example, management should not manipulate the accounting record according to their interests. For example, the best example here is, let's say the company has lots of non-current asset, that has not been used or rarely been used. So they decide to sell off this asset. When you sell off the asset, there is a profit. Let's say the asset you bought is at a low cost compared to the marketable price. For example, the building you buy at 100,000, now you sell off at 250,000. So you're actually making a profit of 150,000. So when you recognize that profit in your financial statement, so you will blown up the profit, reporting profit. So this is actually a bias, because the selling of asset is not a business transactions. When it's not a business transactions, it would be a bias to the user looking at the financial statement with a high reporting profit. Profit is not actually from business transactions. So it's not that the management is become efficient, but it just because due to the selling of the asset. So your financial statement must provide an explanation to the users, so that the user will acknowledge, will know that the high reporting profit because of the selling of asset, not because the business transactions or the business operation becomes more efficient or more productive. So financial statement should be prepared in such a way that is not biased to any user. So all the user will have the same view to your financial statement. Okay, next is the materiality. The materiality concept saying that which are the item has significant effect to the company's or the business financial statement. However, this is a very subjective manner, and this materiality concept usually need the exercising of informed judgment from the accountants. For example, there is in your business has a rubbish bin or a dumpster. If the value of the rubbish bin is not material enough to be considered as asset, So you will report it as other expenses. It's just an expenses. Then it should not be carried forward for the next year in next year, even though you can still use the rubbish bin for the next year. However, the materiality concept say that if the value of that rubbish bin is not material enough, so you just report as expenses. However, if the dumpster, the value of the dumpster is a very, very material. For example, you need to have a specialized industrial bin that contains some chemical waste, for example. So if the value is material enough to be considered as asset, so you will report that item as a non-current asset, that will be bring forward, the value of the asset will be bring forward for the next year. That's all for now. Thank you for watching. Please watch out for the next video for the next topic.